Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We go over what's impacting mortgage rates on a daily basis, whether it might come from the economic calendar or from headline news or geopolitical, sometimes combination of the two or three. But also, market sentiment changes, and good news is now bad news, and vice versa, and that could get really confusing for somebody who might be just kind of sitting on the sideline and watching and wondering why this economic data came out. It's good, but why is the market reacting so negatively to it? So we try to get into the bits and pieces of that as to what's on investors' minds and why they're acting the way they're acting and how they're proceeding to give you better information for yourself. So a little bit about myself is I am a loan officer. I do work as with a national lender. I do loans in all 50 states. So if we could be of service to you in your purchase or refinance needs, please reach out. We'd love to be able to help talk to you a little bit about how we can help you guys out. But we're also here as a resource for you folks. So if we can, if you guys get questions about anything, please reach out. We're here to try to help you guys out. Uh, to move along here, we'll start off with the economic calendar. We'll start off with what we get every Thursday is the jobless claims. So last week there was 235,000 people applied for unemployment. Forecast supposed to be at the same pace at 235,000, and it came in a little hot at 244,000. So lately we've seen an uptick in this. So it'll be interesting to see jobs numbers coming in for the month of July. See if that changes because we've been seeing an uptick in jobless claims of late. However, if you look at the continued claims, that last week's was revised slightly lower from 1.375 million down to 1.372. Forecast actually showing for it to increase to 1.383. However, it dipped. So instead of going upwards, it dropped some, which is obviously good news because that means more people are leaving the unemployment and getting jobs. So that's at 1.331 million. So here's some inflation data. It shows only partial because it doesn't show the headline year over year. But if you look at and this is the wholesale inflation level, it doesn't get. We always like to call this the Rodney Dangerfield of this data because it doesn't always get the respect. Sometimes when higher costs are incurred by wholesales, it doesn't always get passed on to the consumer, so that's why it doesn't always get the respect. But because inflation is such a hot topic these days, it's getting a little bit more respect of late. Especially now that inflation is getting higher and higher, they're hoping that they see it peak, and that's what they're probably going to hope to see here. So this is, of course, for the month of June. PPI last month, back in May, was revised slightly higher from 0.8% to 0.9%. However, forecast supposed to keep the same pace, or the previous pace at 0.8, and it came in a little hotter at 1.1 for the month of June. Now, if you recall, just like the CPI report, the headline news came in a little hotter, primarily because energy costs went up. At one point we even had, I believe, oil price per barrel was around 120 bucks a barrel. So a lot of this stuff was higher. Now, if you strip out the food and energy, we get what they call the core. And so in this situation, the core PPI month over month, so we started May's was at revised slightly higher too, at 0.5 to 0.6%. Forecast was at 0.5%, and this is at 0.4%. So it came in a little bit shyer, a little less hot for the month of June. Now, year over year May was revised higher from 8.3% to 8.5%. Forecast was showing a dip to 8.1%, and it came in at 8.2%. So not quite to expectations. However, it did lower even with the higher before the initial revision there, the 8.3%. So it's even came in a little bit better than that. So which is obviously good news. Kind of like the CPI report. CPI came in a little bit less, and the core CPI came in a little less, and that was because we took out the food and energy. But however, we do need to keep an eye on food and energy because those are costs that are incurred and do eventually, if it's sustained long enough, that will get absorbed into the economy. So, what are the markets doing today? Well, these, of course, we also got the first day of corporate earnings reports, and a lot of people are missing the report. So a lot of the big banks, as a sector for the most part, are down on the day, like J.P. Morgan Chase. We got Morgan Stanley, a few people like that. As a result, a lot of their stocks are their market shares down today as a result. They were kind of disappointed with the earnings reports that came in, and these are the Q2 earnings reports. Today is the first day, so we'll continue to see more through the different sectors in that. But today happens to be one that's starting off. It would be the big banks. So stock market is down and bond market is down. As you can see, bond market was actually down a lot further here. And as a result, we've also had yesterday, if you recall, they talked about the after the CPI report that they think now went from 6% to 42% possibility of the Fed raising the Fed funds rate by 1% instead of 0.75%. Now that raised the odds even further to 75% chance of that. So much greater chance of 1%. So the markets are reacting to obviously much more stringent, more hawkish possibility here at the end of this month. So in another 2 weeks, that's when the Fed will be giving their rate decision and their announcements after their FOMC coming up. So it won't be next week, but the following week. So be prepared for that coming in. So, and then we've had a few Fed speakers that did not dismiss the notion. So that concern remains out there for a lot of investors. So a lot of investors are pulling money out from equities as a result. And then on top of it, we were down quite a bit. So right now we're down 20 basis points. So we're still worse. Pricing is still worse than what we had yesterday. However, it's not as bad when the markets first opened up, primarily because we were much worse positioned. But since then, we've subsided a little bit. But we're still south of the 25-day moving average. So that's something we'll hopefully get reversed and get back above that to put us in a better threshold. We did that once before, if you recall. Where was it? Right here. We broke below that, and then next day we went upwards. So that was Friday. We broke below it, and then Monday brought us back above it. So we'll wait and see if we can get our foothold back above the 25-day moving average. Hopefully that could be a good floor of support for us, and then hopefully boost us a little bit more and get some better pricing as we go through the summer here at least. Do expect rates long-term to continue rising. Some people are projecting even 7% range, so that is a possibility. So to move on here, here's the 10-year Treasury. We are still under 3%, even though we did test that earlier today. We did touch the 3.0, basically 3.03 level here, but right now we're just under 2.96. So like its counterpart, it did subside a bit and has come down a little bit. Right now we're just under 2.96. So lastly, we'll touch on the interest rates, conforming limits, the average interest rate for conforming limits. Again, these are 1 day delayed, so these are based off yesterday's results, as well as they do have points built into them, so they aren't in 8th increments like we usually quote. So the 15-year is currently at 5%, and the 30-year is now at 5.77%. So if you guys got questions about anything, again, we're here to help you guys out. If you like a rate quote, again, reach out. We're here to help you guys out. In general, we are here to help you guys. So we appreciate you guys' time and energy to watch our videos. And if you guys like these videos, please help us out. We'd greatly appreciate it if you could help us out by expanding, helping us boost our channel here, and share and like the videos. We greatly appreciate that. Thank you so much. Have a great rest of your day, and we'll catch you guys tomorrow. Bye-bye.